So, welcome to the investing in fixed income securities. In this section, we are talking about the features, basically the basic features of a bond. So, now, as we know from the first part, bond is a long-term debt securities, and that needs automatically that there had to be some features which are reliable for the bondholders and which are the obligatories from the bond issuer. So when we talk about the bond interest and the principal, we have to talk about the maturity date, the principle of bond price behaviors, and the quotation. Let's start with the bond interest and principal. Any bonds comes with a coupon. The coupon in general is the interest rate that the bondholder gets on an annual basis. That's why it's called also very often nominal interest. So if I do invest 10,000 in a bond and I have a 5% coupon, I get on an annual basis $500 interest. If I invest 5,000 into the bond, I get $250 interest. Most of the bonds are coming with a par value, face value, also principal value. That's basically the value that the borrower needs to repay back to the bondholders. In most cases, the par value is 100 or 1,000. The coupon rate is nothing else than the coupon which I get on the bond divided by the par value. Since the par value is 100 or 1,000, then the coupon and the coupon rate in general are the same. Different to the coupon rate is the current yield. The current yield at the end is that what I earn on the bond on the annual basis if I purchase the bond on the market and keep this bond to the end of the maturity, when the money gets repaid from the issuer. Since the price of the bond can fluctuate on the market, which we will see later on, the current yield can be either higher than the coupon rate or lower than the coupon rate. Now let's look at the maturity. The maturity date basically gives us the date when the issuer of the bond will repay the money. The maturity in general is fixed, so it's a fixed date in the future. And during this maturity date, the bondholders are holding the bond and the bond stays alive. The difference between term bonds and serial bonds is that in general the term bonds having only one maturity date. So many bonds are issued, but there is only one date in the future where these bonds are repaid to the bondholders. While on the serial bonds, there have been many maturity days. Could be 5 maturity days, could be 10 maturity days, could also be 2 maturity days, but there are more different dates. The difference between a bond and a note is in general the length of the maturity. While when we talk about notes, we have 2 to 10 years of maturities, while on the bonds we have 10 years upwards, also 10 years and 5 months, for example, up to 30 years most of the time. Let's come to the price behavior. As we have learned in the video, that there is certainly a demand and a supply on the bonds during their lifetime. Since the bonds coming with a fixed coupon and a fixed maturity, the market interest rate, the current yield, is changing depending how the price of the bonds are changing on the market. For this, the price can go above par value, either above 100 or 1,000. That's what we talk about then, a premium bond. So any bond which is traded above 100 or 1,000 is called a premium bond. The opposite is if the bond prices are falling, in case the interest rates are rising, Then we talk about a discount bond when the price goes below 100 or 1000. The price of the bond being a premium or a discount bond has certainly then an impact of the current yield. Let's have a look on the chart. When we have the par value of the bond being 1000, we can see that any premium bond is above 1000 and any discounted bond is below 1000. If the coupon rate of a bond is 10%, then a bond which is traded with a premium certainly have a lower interest rate. Because when we pay more than 1000 for the bond and getting 1000 back at the end, the overall current yield is below 10%. In this case, the red line 9 and the blue line 8%. On the opposite, if the bond is traded on the market below 1000, because we believe that the interest rates are going up, then the bonds are traded with a discount, and the interest rate of the bond will be then higher than the coupon rate, meaning 11% or 12% respectively. So, as we have seen now that bonds can be traded above 1000, above par value, or below par value, above premium bonds, below discount bonds, we know that they are traded on the market. But the quotation of the bonds are not as widely seen in the financial press like the stocks. In general, the bond prices are expressed in percentage of par. So if I have 1000 par value, there will be 100% as a quote. If I have 100 as a par value, it will be also 100%. Means at the end, 100% of the money will be paid back by the end of the maturity. So when we look on the quote of 87.562, it will be translated in an 87.562% of par value, or 875,602 for a bond which has a par value of 1000. The US Treasuries and the agency bonds, agencies being subsidiaries from the US government, are quoted in 30 seconds of a point, meaning we have 1.35s, 16.32s, 8.32s, and so on. Now let's have a look how the quotation is on quotation systems. We're going here to the Börse Stock Exchange of Stuttgart. And look at the Apple bonds outstanding with US dollar domination. We will see here that there are 38 bonds. Now what we see here is on one side the security identification number from an Apple bond, then the issuer, which is Apple. The interest rate is known as the coupon rate. So that's an US dollar bond with 2.5 on a coupon, 1.2432 or 1.125 on a coupon of 3.2 coupon. Now, we're coming to the maturity. We see here that each bond has its own maturity date. So this bond will be paid back on the 9th of February 2025. This bond will be paid back on the 11th of May 2027. Very important for the investors are the yield, the current yield. Now, as we learned before, that premium bonds being traded above par value, having a current yield which is lower than the coupon rate, and discount bonds, which are traded below 100 or 1000, having a current yield which is above the coupon rate. Now we can say we have a yield, current yield of this bond, which is 0.87% approximately. We see that the current yield is lower than the coupon rate. And for that, we can say that this bond is trading above 100 or above 1000. So it must be a premium bond. When we look in the detail of these bonds, we can confirm that. So we see that the bond is traded with 100.19 to 102.49. That basically the proof that this bond is a premium bond. On the opposite, we can see when we look at the bond, which is current yield higher than the coupon rate, which is not easy to find nowadays, but that would be one. So here we have a current yield of 2.525, while the coupon rate is 2.375. Meaning current yield be higher than the coupon rate. The bond is a discount bond. It's traded below 100. And if we look at the details of these bonds, this will be confirmed. So, as we see, the bond is traded below 100%. So it's 97% to 97.74. Also here we have the bid and the ask, similar to the stock price. The bid is the purchaser side, the ask is the seller side, meaning the demander side on the bid side and the supplier side on the ask side. When we look on the chart of this kind of a bond, we can see that also the bonds have some kind of a volatility in the price quotations, especially in certain events when the investors believing whether the interest rates in the future are going up, then they're selling the bonds because they have the opportunity to reinvest it for higher interest rates. Or when they believe that the interest rates are going down, then they going into the bond, they're demanding the bonds, the price going up because they know or they believe that the interest rate later on are lower. Now, here we are back then to the overview of the bond issues of Apple. As we've seen, Apple has approximately 38 bonds in US dollar. Apple also issued bonds in euro or British pound, but that will be looking on that later on. Good. Now you learned a little bit about the basic features about a bond, especially the coupon bond, the difference to the coupon bond and the current yield, the maturity date, that there are serial bonds and term bonds, and the quotation, that there is a discount bond where the quote of a bond is below the par, below 100, and a premium bond where the price is above 100, meaning above par.